Since the end of World War II, the US dollar has held a unique position in the global financial system. As the primary reserve currency, it underpins international trade, investment, and central bank reserves worldwide. This dominance gives the United States significant economic influence, allowing it to borrow cheaply and dictate global monetary trends. But what if this dominance begins to waver? Understanding the dollar's role today is essential to foresee the consequences of any future decline. The dollar serves as the primary medium of exchange in global trade, from oil to technology. Nearly 80% of global transactions involve the dollar, making it the world's most trusted currency. Companies and countries rely on the stability of the dollar to price commodities, settle trade balances, and manage financial risk. A weakening dollar could disrupt global trade flows, increase transaction costs, and destabilize markets that depend on it. Central banks worldwide hold dollars as a major portion of their reserves. This reserve currency status not only stabilizes the dollar but also strengthens the US financial system. Any significant shift away from dollar reserves could trigger a ripple effect through global financial markets, impacting interest rates, inflation, and capital flows. The question arises, are nations already preparing for alternatives? The petrodollar system, established in the 1970s, ties global oil trade to the US dollar. Oil exporting countries price and sell oil exclusively in dollars, reinforcing demand for the currency. This mechanism has strengthened US geopolitical influence, creating economic dependencies that ripple across continents. Any threat to this system could create unprecedented energy and financial shocks globally. The dollar's strength reflects the health of the US economy, which attracts foreign investment and supports trade. A strong dollar provides purchasing power for Americans but can harm exports by making them more expensive. Conversely, a sudden drop in the dollar's value could trigger inflation, reduce investor confidence, and destabilize markets, both domestically and abroad. Many nations borrow in US dollars, creating dollar-denominated debt obligations. This dependence exposes them to exchange rate risks. If the dollar falls, countries with significant dollar debts could face relief from repayments, but it may trigger global market volatility. Corporations, governments, and financial institutions are deeply intertwined in this network of dollar debt. The dollar dominates international investment markets. Stocks, bonds, and derivatives are often priced in dollars, attracting global capital seeking safety. A shift in the dollar's value would reshape investment strategies, potentially triggering capital flight, volatile equity markets, and a global liquidity crisis. History offers lessons. Empires that dominated trade and finance, such as Britain with the pound sterling, eventually saw their currencies decline. The transition was gradual but disruptive. Understanding these historical precedents helps us predict possible scenarios if the dollar loses its primacy in the 21st century. The dollar's strength underpins US geopolitical influence. From sanctions to global aid, Washington leverages the dollar to shape international policy. A declining dollar could weaken these tools, emboldening rival powers, reshaping alliances, and creating a multipolar economic landscape. The stakes are not just financial, but geopolitical. As we explore the potential fall of the US dollar, the global economy stands on a precarious edge. Trade, finance, investment, and geopolitical stability are intricately connected to this single currency. The next parts of our documentary will examine in detail the possible scenarios, consequences, and strategies nations might adopt in response to a declining dollar. The value of a currency is influenced by multiple factors, including interest rates, inflation, trade balances, and investor confidence. The US dollar, despite its global dominance, is not immune to these forces. A weakening dollar may begin subtly, with small shifts in exchange rates, before escalating into a broader financial phenomenon. Investors, traders, and nations closely monitor these movements to anticipate potential disruptions. The Federal Reserve controls US monetary policy, influencing interest rates, money supply, and inflation expectations. Aggressive money printing or prolonged low interest rates can reduce the dollar's value. Conversely, tight monetary policy can strengthen it. Understanding the Fed's decisions is crucial, as they ripple across global markets and impact the stability of nations holding dollar reserves. The United States carries the largest national debt in history. Growing fiscal deficits, funded by issuing treasury securities, can increase the supply of dollars globally. If foreign buyers lose confidence in US debt, demand for the dollar may decline, triggering depreciation and increasing borrowing costs. The delicate balance between debt, deficit, and global confidence is critical to currency stability. A persistent trade deficit weakens a country's currency by increasing demand for foreign currencies. The US imports more than it exports, creating significant dollar outflows. Over time, this can reduce global confidence in the dollar, especially if paired with economic or political uncertainty. Understanding trade flows is essential to forecasting potential dollar depreciation. Political instability and global conflicts can weaken confidence in the dollar. Sanctions, wars, and diplomatic tensions may prompt countries to diversify away from the dollar. Rising geopolitical competition from nations like China and Russia challenges the US dollar's uncontested dominance, introducing long-term risk to its global value. Emerging economies increasingly explore alternatives to the dollar for trade and reserves. The Chinese yuan, digital currencies, and regional trade agreements provide options outside the dollar-centric system. While adoption is gradual, a critical mass could reduce demand for the dollar, accelerating its decline and reshaping global financial networks. Currency markets are influenced by psychology as much as fundamentals. Speculators can accelerate dollar movements, amplifying both gains and losses. A sudden shift in investor sentiment, triggered by news, policy, or global crises, can spark rapid depreciation, creating market volatility that impacts trade, debt, and investments worldwide. Digital currencies, including central bank digital currencies, CBDCs, and cryptocurrencies, are increasingly challenging traditional financial systems. If widely adopted, they could reduce reliance on the US dollar for cross-border transactions. This evolution, though gradual, represents a potential structural shift in global finance, influencing the dollar's long-term stability. History offers valuable lessons. The decline of the British pound in the 20th century, the Asian financial crisis, and the European debt crisis illustrate how over-leveraging imbalances and sudden shocks can devalue dominant currencies. Understanding these patterns provides insight into how a dollar decline could unfold and impact global stability. Tracking the dollar requires monitoring key indicators: foreign reserves, debt levels, trade imbalances, interest rate trends, and geopolitical developments. Early warning signs, such as declining foreign holdings of US Treasuries or rising competition from alternative currencies, can signal the beginning of a larger trend. Recognizing these signs is critical for governments, investors, and businesses to prepare for potential shocks. A sudden decline in the US dollar would send shockwaves across global financial markets. Stock indices, bond yields, and commodity prices would experience extreme volatility. Investors may flee to safer assets like gold or the Swiss franc, creating temporary liquidity crises. The interconnected nature of the financial system means that a dollar drop in New York can instantly affect markets in Tokyo, London, and Singapore. A weaker dollar raises import costs for countries that rely on US goods or commodities priced in dollars. Rising import prices can trigger inflation, eroding consumer purchasing power and increasing the cost of living globally. Countries with significant dollar-denominated debt could face compounded challenges. As repayment obligations become more expensive in local currency terms, emerging economies are particularly vulnerable to a falling dollar due to high levels of dollar-denominated debt. Countries in Latin America, Africa, and Asia may experience debt stress, currency devaluation, and capital flight. Economic instability could lead to social unrest, political instability, and even sovereign defaults if corrective measures are not implemented quickly. The dollar is the anchor of international trade. A sharp decline would disrupt pricing, contracts, and supply chains. Exporters may struggle to adjust, while importers face higher costs, causing shortages and delays. Global supply chains, already stressed by geopolitical tensions and pandemic disruptions, could experience amplified turbulence. Global banks and financial institutions are heavily exposed to dollar-denominated assets. A declining dollar could trigger mark-to-market losses, reduce liquidity, and force banks to adjust their portfolios rapidly. Stress in the banking sector could spread to credit markets, making borrowing more difficult for businesses and governments worldwide. Most commodities, from oil to metals, are priced in dollars. A falling dollar would initially make commodities cheaper in local currencies, but it could also trigger speculative volatility. Energy prices, essential for global economies, might spike or collapse unpredictably, affecting manufacturing, transportation, and consumer costs worldwide. A weaker dollar can weaken US geopolitical leverage, emboldening rival nations. Countries may form alternative trade agreements and reserve currency systems to reduce dollar dependence. This could lead to a multipolar global economy, with new alliances, strategic rivalries, and potential conflicts reshaping the international order. Economic instability from a falling dollar can quickly spill into society. Inflation, unemployment, and reduced access to global markets can trigger protests, political unrest, and policy shifts. Governments may face pressure to implement drastic economic reforms or seek emergency aid, altering domestic politics and global influence. Central banks worldwide may intervene to stabilize their economies. Measures could include currency interventions, interest rate adjustments, or expanding reserves in alternative currencies. Coordinated action might mitigate some damage, but the scale of a rapid dollar decline could overwhelm even the most prepared institutions. Over time, a declining dollar could reshape global trade, investment, and currency hierarchies. Nations might diversify reserves, strengthen regional trade blocs, and reduce reliance on US financial instruments. While immediate chaos is likely, The long-term outcome could be a more multipolar global economy with redistributed financial power. If the dollar begins to fall, the US government would likely act swiftly to stabilize confidence. Policy measures may include adjusting fiscal spending, negotiating trade deals, or implementing emergency financial programs. While these interventions can provide temporary relief, the effectiveness depends on global perception and the scale of the decline. The Federal Reserve holds a critical role in responding to a weakening dollar. Options include raising interest rates, buying or selling treasury bonds, and adjusting monetary supply. Such measures aim to restore investor confidence, reduce inflationary pressures, and stabilize the currency. But timing and execution are key to success. Countries heavily reliant on the dollar may take defensive steps to protect their economies. These include diversifying reserves into euros, yuan, gold, or cryptocurrencies, hedging dollar exposure, and renegotiating contracts. Such actions can reduce vulnerability but may also accelerate a broader shift away from the dollar system. Coordinated action among central banks may help limit global fallout. Through currency swaps, interest rate alignment, and emergency liquidity provisions, central banks can stabilize foreign exchange markets. However, conflicting national interests and political pressures may complicate unified responses. Multinational corporations can mitigate dollar risk through hedging instruments such as futures, options, and swaps. By managing currency exposure, companies can protect profits and maintain operational stability. The effectiveness of these strategies depends on market liquidity, timing, and the speed of dollar movements. Global investors would react quickly to a falling dollar. Strategies might include increasing exposure to non-dollar assets, precious metals, emerging market currencies, and diversified global portfolios. Investment behavior can amplify trends as collective movement towards alternatives affects liquidity, market sentiment, and asset pricing. As confidence in the dollar weakens, nations and institutions may adopt alternative currencies for trade and reserves. The euro, yuan, and emerging digital currencies offer options. Wider adoption can shift global financial patterns, reduce dollar reliance, and create a more multipolar currency landscape. Historically, gold and other commodities serve as safe havens during currency instability. Investors, governments, and central banks may increase allocations to gold, silver, and strategic resources. This inflow can stabilize wealth preservation but may also cause commodity price volatility, affecting global markets. Trade contracts may shift away from the dollar toward alternative currencies. Countries may form regional trade blocs, settle transactions in local or digital currencies, and renegotiate pricing structures. These adjustments could gradually reduce the global dependency on the dollar, reshaping international commerce. Institutions, governments, and investors must prepare for multiple scenarios. Strategic planning may include strengthening domestic financial systems, diversifying currency exposure, and building economic resilience. While immediate interventions can stabilize markets temporarily, long-term adaptation is crucial for navigating a world with a potentially weaker dollar. A declining dollar directly affects import prices, translating into higher costs for goods and services globally. Essential commodities like food, fuel, and medicine become more expensive, straining household budgets. Consumers face inflationary pressures, which can reduce purchasing power and trigger social discontent in affected countries. Households with loans tied to global interest rates may experience increased debt burdens. Mortgage rates and credit costs can rise as financial markets adjust to dollar fluctuations. Families and individuals must manage these financial pressures while navigating an uncertain economic landscape. A weaker dollar can influence corporate profits, especially for multinationals with foreign revenue streams. Companies may reduce payrolls, freeze hiring, or adjust wages to manage costs. Employment instability can ripple through economies, affecting millions of workers worldwide. Small businesses reliant on imported materials or exports face immediate challenges. Rising import costs and unpredictable currency conversions can erode profit margins. Some businesses may close while others adapt through price adjustments or new suppliers, highlighting vulnerability at the local economic level. Individuals with investments tied to U.S. assets or global markets experience portfolio volatility. Retirement funds, pension plans, and savings may lose value temporarily, requiring reassessment of risk strategies. A declining dollar emphasizes the importance of diversification and long-term financial planning. International travel and tourism are affected as the dollar weakens. Americans traveling abroad gain more purchasing power, while foreign tourists find the U.S. more expensive. Airlines, hotels, and travel businesses adjust pricing, influencing global tourism patterns and local economies. Commodities like oil, gas, and metals, often priced in dollars, see immediate price adjustments. A weaker dollar can make imported goods costlier for non-US countries, impacting fuel prices, transportation, and manufacturing costs. Daily life and basic necessities are directly affected. Millions of people rely on remittances sent in dollars from abroad. A declining dollar reduces the value received by families in other countries, affecting household income and local economies. Currency fluctuations may also increase transaction fees and reduce the reliability of cross-border transfers. Economic uncertainty caused by a declining dollar can have profound psychological impacts. Fear of inflation, job insecurity, and rising living costs contribute to anxiety and stress. Communities may experience tension, reduced consumer confidence, and shifting societal behaviors. In a world facing potential dollar decline, personal financial resilience becomes essential. Individuals can diversify assets, invest in stable currencies, precious metals, or real assets, and maintain emergency funds. Awareness, planning, and strategic adaptation are key to mitigating personal economic risk in an unpredictable global environment. If the US dollar loses its dominance, the global financial system may shift toward a multipolar currency structure. The euro, Chinese yuan, Japanese yen, and emerging digital currencies could share global influence. Such a system may increase financial competition, diversify reserves, and reduce dependence on a single currency. But it also introduces complexity and potential instability in international trade. Nations may form regional trade blocs to reduce reliance on the dollar. Agreements between countries in Asia, Africa, and Latin America could facilitate local currency settlements, strengthen regional economies, and create new geopolitical alliances. This realignment may redefine global trade patterns and influence international policymaking. Central banks may diversify their reserves further, balancing gold, euros, yuan, and cryptocurrencies. A reduction in dollar holdings could stabilize individual economies but change international capital flows. Strategic reserve management will become a key tool for mitigating financial shocks in a post-dollar world. Digital currencies may accelerate their adoption as alternatives to the dollar. Central bank digital currencies, CBDCs, and cryptocurrencies offer efficiency, transparency, and cross-border settlement advantages. Their widespread use could reshape international finance and challenge traditional banking models, offering new pathways for global economic interaction. A declining dollar forces nations to rethink debt denominated in US currency. Countries may negotiate refinancing, switch to local currency debt, or restructure obligations to maintain financial stability. These changes can reduce exposure but may also create tensions in global lending and investment relationships. Post-dollar decline. Countries may implement recovery strategies including industrial diversification, strengthening domestic production, and enhancing technological capabilities. A focus on self-reliance, innovation, and regional cooperation can mitigate economic shocks and foster long-term resilience. A weaker dollar redistributes geopolitical and economic influence. Emerging powers may gain leverage in global policymaking while traditional powers adjust strategies to maintain relevance. The global balance of power may evolve. With economic strength increasingly tied to regional integration and currency diversification, investors, corporations, and financial institutions must adapt to a restructured currency system. Diversifying portfolios, hedging risks, and investing in emerging markets or commodities becomes essential. Markets gradually stabilize as participants adjust to new norms, creating opportunities amid uncertainty. The decline of the dollar offers lessons in economic resilience, strategic planning, and global cooperation. Nations and individuals alike must prepare for volatility, diversify risks, and embrace innovation. Understanding these lessons ensures preparedness for a dynamic, interconnected financial future. While the fall of the US dollar may trigger immediate chaos, it also opens pathways to a more diversified and multipolar global economy. Innovation, strategic collaboration, and financial adaptability will define the future. Nations, institutions, and individuals capable of navigating this transition may emerge stronger in a rebalanced world order.